Financial analysts have developed so many different calculations to help estimate a stock's fair price. They can all be valuable in their own right, but I'm happy to report that not all investors need to know every one of them. There are 5 common financial ratios that many investors find particularly useful to identify investment opportunities. So let's introduce them. Keep in mind that these ratios work best when used to compare companies in similar industries or the same company across time. Without further ado, here they are. Number 1, price to earnings or PE ratio. This ratio compares the stock's current market price to its earnings per share or EPS. Price to earnings is also known as the PE multiple. Generally, investors want the ratio to be as low as possible because that means they aren't paying a large premium to buy a stock that's profitable. However, investors who are looking to buy into growth companies might be more comfortable with higher PE multiples. That's because they expect future earnings to offset the cost of buying the stock at what appears to be an overvalued price today. Number 2, price to earnings to growth or PEG ratio. The PEG ratio takes the PE multiple another step further. It divides a company's price to earnings ratio by its expected future earnings. This aims to give investors a sense of how much they're paying today for the company's profitability down the line. This is often useful when evaluating growth stocks since their price depends more on future earnings than present ones. Like the PE ratio, a low PEG can indicate that a stock is undervalued. However, keep in mind that the ratio is only as accurate as the estimates of those future earnings. Number 3, price to book or PB ratio. This ratio compares the stock's current price per share to its book value per share. You can think of book value per share as simply the money each shareholder would receive if the company's assets were liquidated. Generally, the lower the price to book ratio, the more attractively it's priced. And if the ratio is less than 1, the stock's current price is lower than the value of the company's assets. Number 4, debt to equity or DE ratio. This ratio measures how much a company is borrowing money to fund its operations. It divides total liabilities by shareholders' equity. You can find both of these figures in a company's balance sheet. Make sure to check out our lesson on that for more details. A higher debt to equity ratio usually translates to higher risks for shareholders. If the company shuts down, it must repay its debtors before its shareholders. However, a higher debt to equity ratio can also signal the potential for high returns. Let's say a company takes out a loan from a bank to expand its business. If it can increase profit by more than the amount of the loan payments, then the reward might be worth the risk. Number 5, dividend yield. The dividend yield is the percentage of money investors receive as dividends for the year divided by the current stock price. In most cases, a higher dividend yield is desired. However, there are a couple of things to consider that might make a very high dividend yield less attractive. First, the dividend yield will rise when the price of the stock falls unless the company lowers its dividend, neither of which are ideal scenarios for investors. Second, how stable is the dividend? Be wary of companies that pay out dividends infrequently or change the amount often. The longer a company pays its dividends without lowering it, the more stable it's considered to be. That brings us to the end of our short list of key ratios. Of course, there are many ways investors can measure a stock's value, and investors are often best served by considering as many metrics as possible. That can take a lot of time, but luckily, WebBroker has tools that can help cut down research time. Learn more in our lesson, How to Research Stocks Using Ratios in WebBroker.